Since the start of human civilization, around 200,000 tons of gold has been mined. To put 200,000 into perspective, it's pretty much the weight of that ship which was stuck in the Suez Canal for a week or so. Now, jewelry takes up about half of it. 20% is in the form of coins, gold mutual funds, ETFs, etc. The next 18% is with the central banks of the world, and the balance goes into our smartphones, microchips, medicines, and even tooth fillings. So some of it is for consumption, but there is also a sizable chunk that is tagged as investable gold, which is what we'll be examining in this video. But first, let's make a case for why one should invest in gold. Now, gold isn't for everyone, and especially if you are a true Warren Buffett fan. And as much Mr. Buffett has expressed his dislike for gold, I should mention he has bought about 3,700 tons of silver, which comes to $1 billion. But here's what I want you to consider. Number one, over the previous 40 years, gold has delivered a respectable CAGR of 9.2%, and if I had done an annual SIP, this number goes up to 10.5%. Point two, and more significantly, the price of gold has fallen only 7 times on an year-on-year basis in those last 40 years. Even in terms of downside, the maximum the price of gold has fallen over a year is 14%, which is a lot better than the BSE Sensex, which has had an yearly fall of 14% or more on 7 different occasions. Okay, what else? From a risk perspective, gold is a lot less volatile as compared to equities. And pleasantly, gold and the stock markets have a sort of inverse correlation, which makes gold an extremely efficient hedging tool when doing asset allocation. In fact, this chart here clearly shows how well gold performs when the stock markets are depressed or when there is some sort of financial calamity like what we saw in 1991-92, the year 2000, 2008, 2009, in the year 2020, and we are seeing it again in 2023 when the economic climate is a bit cloudy. So gold has its advantages, and I for one have always recommended that investors should have around 10% of it in their portfolios. Which brings us to the next question: how can one buy gold? So gold is available for purchase in the physical format, jewelry, gold coins, bar, bullion, etc. and can also be bought electronically via instruments like digital gold, ETFs, gold mutual funds, and of course the sovereign gold bond. Now, there is already a lot of information on the internet on each of these products, so I won't go product by product, but instead I'll focus on the most important attributes that we as investors should consider when buying gold and how each of the 5 options stack up against every variable. The fact is, gold has always been a very popular subject of inquiry, and I'm sure you'll find small nuggets of useful information in this video as well. And in return, all I ask are for some trinkets, maybe a thumbs up when you press the like button, or if you've already subscribed to my channel, then do get a friend or family member to subscribe as well. With that being said, let's start with variable number 1. Now, physical gold is readily available. You can buy it from a bank branch in the form of gold coins and also as ornaments from your neighborhood jeweler. In fact, it's estimated that Indian households have with them 25,000 tons of gold, which is like 12% of all the gold that has been pulled out since the start of mankind. When it comes to financial products, digital gold is distributed by most fintech companies and is therefore available on many mobile apps. The same is the case with gold mutual funds and ETFs, and you can buy these on aggregator or trading platforms and also on mutual fund websites. It's a sovereign gold bond which is a little time bound as the RBI releases a new tranche every few months. These buying windows are open for 5 days and a list can be accessed from the RBI website. Now, pleasantly, even if you were to miss these buying windows, you can always invest in them from your trading account, as these bonds are tradable on the Indian stock exchanges. So just like how you buy and sell shares in a company, you can buy and sell SGBs, which means at least from an availability point of view, I would say all 5 gold options are sufficiently accessible. The next point of comparison is risk, and physical gold is risky. I mean, there are chances of theft, the quality of gold can be tampered with, some gold might be lost during the making process, etc. On the other hand, digital gold escapes all these complications but comes with one big risk, which is the lack of regulatory oversight. In other words, there is no SEBI, no RBI, and any other regulatory body that supervises or looks into how these companies conduct their business. So while digital gold has a lot of advantages, the current lack of regulations is definitely a big minus. Gold ETFs, gold exchange traded funds, are backed by actual physical gold, which comes at a purity of 99.5%. This gold is stored with the custodian bank in the bank's vaults and is valued periodically as per SEBI guidelines. So this is a big plus for this instrument because A, there is regulation, and B, the financial instrument is actually backed by real gold. Now, a gold mutual fund is simply an extension of the ETF construct, as most gold MFs invest in one or multiple gold ETFs. When it comes to sovereign gold bonds, and this might come as a surprise, but these are not actually backed by physical gold. You see, the SGB is a derivative instrument, which means the government of India is simply using the price of gold to define a value for that bond. So when you invest money in an SGB, it's basically the RBI promising to pay you the bond's maturity amount, which is the price of gold on the date of maturity. Now, from a risk perspective, unless the government of India defaults, I don't see any big risk with SGBs, other than of course the standard reinvestment and inflation risks which are there in all financial instruments. But yes, risk is an essential factor when comparing different gold instruments, and a knowledge of this is hugely important. Physical gold can be bought as jewelry, as pendants, gold bars, etc. But one of the most popular forms is a gold coin. So I think this starts from half a gram, 0.5 grams, which after adding some profit margin, etc., comes to a little over 3,500 rupees at current prices. On the other hand, digital gold is extremely fractionalized and can be bought for as little as 1 rupee. In case of gold ETFs, you need to buy at least one unit, which is 0.01 grams of gold, or about 60 rupees worth of it. Even gold mutual funds have a rather low entry amount, and one needs just 100 rupees to invest through them. In fact, it's only the sovereign gold bond that needs us to buy a minimum quantity of 1 gram. But on an overall basis, the fact that gold is available in smaller quantities and amounts makes it a lot more accessible than other financial instruments. Now, generally, returns are returns and costs are costs. What I mean is, these two concepts are not bunched together in most financial products, but when it comes to gold, returns and costs are the same side of the coin. Let me explain this with some examples and calculations. Now, in the case of physical gold, especially jewelry, there are three major costs: the design and making charges, the cost of storage, and a 3% GST, which put together can cost you anywhere from 10 to 20% over and above the price of gold. Additionally, there is the cost of insurance and a bank locker, which all adds up and makes physical gold a rather weak option, at least from a return on investment perspective. Next up is digital gold, and this is where I'd like you to pay a little attention. Now, much like physical gold, the purchase of digital gold also attracts a GST of 3%, which obviously eats into the returns. But more importantly, there is a big rift between the buying and selling price of digital gold, which one needs to understand as well. So at the time of recording this video, 1 gram of digital gold was costing me 6,400 rupees. And at that very moment, selling that 1 gram of gold would have yielded me 6,029 rupees, which is a good 371 rupees lower than the buy price. So 371 divided by my acquisition price of 6,400 gives me a buy-sell spread of 5.8%, which I think is a bit high. The digital gold company justifies this difference on account of their costs, which include storage, technology, transportation, insurance, and of course GST. But as I said earlier, returns and costs are the same side of the coin, and these simulations here should give you a fair idea of how a higher cost means lower returns for the gold investor. Next, we have gold ETFs, which come with an expense ratio that's typically between 0.5 to 0.7%. In addition to this expense ratio, there are some smaller costs around brokerage, demat account, STT, stamp charges, etc. Okay, on the face of it, gold mutual funds might seem a lot like gold ETFs, but one has to be careful with what they see as the expense ratio. So this list here shows the direct plan expense ratio of many gold mutual funds, and most of them are within the 0.1-0.2% range. But what this list doesn't show is the expense ratio of the underlying asset, which in this case are the ETFs that these mutual funds have invested into. In other words, the actual expense ratio of these gold mutual funds is their own expense ratio plus that of the ETFs. For example, SBI Gold Fund shows us an expense ratio of 0.1%, which is not entirely accurate. And that's because its underlying fund, that is the SBI Gold ETF, has an expense ratio of 0.64% for this month, which gives us a combined and accurate expense ratio of 0.74%. And finally, we have the sovereign gold bonds, which are quite popular in India, having raised around 43,000 crores for the government. And I think a lot of it is on account of the extra return it offers. So firstly, unlike every gold product we've discussed, SGBs have no visible expenses. I mean, forget about expenses. Investors who submit their applications online and pay electronically are actually eligible for a per gram discount of 50 rupees. Secondly, SGBs offer a fixed interest of 2.5% per annum on one's initial investment. This interest is credited to the investor's bank account twice a year, and it's a feature that none of the other products have. So effectively, if the gold appreciates by 9% every year, then the SGB offers 9 plus 2.5, so that's an expected return of over 11%. In comparison, gold ETFs will be 9% minus say 0.6%, so that's an yield of 8.4%. Gold mutual funds might be a dash below this number, so say 8.3%. By my reckoning, digital gold, because of that buy-sell spread, would deliver somewhere around 7.7% over a 5-year period. And physical gold, well, it's going to be the least of the lot. So when it comes to returns, the sovereign gold bond clearly leads the race. But let's not declare them a winner yet, because we still have liquidity and taxes to worry about. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. Alright, so liquidity is not a problem in most cases. For instance, if you have ornaments or gold coins, then any jeweler will buy those and pay you probably on the same day. In case of gold ETFs and mutual funds, these can be liquidated during trading hours, although it might take a couple of days for the money to hit your bank account. And digital gold is the most liquid of the lot, and units can be sold 24/7. Now, in my view, liquidity as an attribute is important because traditionally gold in India is considered more of a savings instrument. And so if the family needs money for whatever reason, then the gold in the family should be highly accessible and liquid. When it comes to SGBs, there are some terms and conditions we need to be aware of. So sovereign gold bonds come with an 8-year maturity, but early redemption is possible in a couple of ways. The first is via the secondary market, where one can demat their bonds after 6 months of issuance and can then put it up for sale on the Indian Stock Exchange. The second option is to prematurely encash your bonds, which the RBI allows after a period of 5 years. Now, if you don't want to use either of these two options and want to hold to these SGBs until maturity, then you can also opt for a loan which is available against these bonds. For instance, the State Bank of India allows up to 20 lakhs as loan, and it offers an LTV of up to 65% on the bond's market value. I'd also like to point out that while the secondary market is one way of selling SGBs, because of the low liquidity there, these bonds often sell at a discount. Not always, but most of the times, which is good if you are a buyer, but not that good if you are a seller of these bonds. So if you want to buy SGBs, then do examine the discount and yields of existing bonds in the secondary market using a website like sgbanalyzer.com, which has done a great job of compiling the necessary information. The final comparison element are the taxes which one might have to pay at the time of buying, at the time of selling, or at the time of maturity. When buying gold, and we discussed this earlier, a 3% GST is charged when buying physical or digital gold. At the time of selling gold, different products follow different rules. For instance, capital gain tax on physical gold and on digital gold depends on the holding period. So if this is less than 3 years, then the investor's marginal tax rate applies. And if the gold is sold after 3 years, then it is taxed at 20% with indexation benefits. In the case of gold ETFs and gold mutual funds, there is now no concept of holding period, and therefore any gains made are now taxed per the slab rate applicable to you. If you want more details on this, then do watch this video on my channel, where I not only explain the law, but also offer some viable solutions for people who generally invest in fixed income instruments. Okay, now let's come to the sovereign gold bonds. So firstly, the 2.5% interest that one receives every year, well, that has to be added to one's income, and your prevailing income tax slab also applies on it. Secondly, if the SGB is redeemed at the end of 8 years, that is at maturity, then the capital gains made on this instrument is entirely tax-free. Now, from what I've read, this tax-free at maturity rule is applicable irrespective of whether you bought the SGB during its launch or if you bought it from the secondary market, which I think will be very comforting to a lot of us. Remember, I also said the RBI allows investors to redeem prematurely after 5 years. In this case, and again I have read this and I'm enclosing the source in the video's description. So what I've read is that this kind of RBI allowed redemption in the 6th, 7th or 8th year is actually tax free. But I read another article where it says that it's not tax free. So please, I am not a tax advisor and therefore kindly consult someone who actually does this for a living, as there might be some inaccuracies and some ifs and buts around this point. So have a view on this, but there is no doubt that tax is an important factor when choosing a gold instrument. Point blank, India is a gold country in more ways than one. And just to prove it, figure this, India has more goldsmiths, sunar ki dukan, as compared to the number of bank ATMs. So gold has a special place in our hearts, and I hope this video has helped you narrow down the type of gold product that best addresses your investment needs. To put it together, we looked at 5 popular gold products and we evaluated each of them on the basis of their availability, risk, starting investment, returns, cost, liquidity and taxes. On top of this, investors should also look at their objective of buying gold, the period for which they require it, the safety aspect of it, etc. before coming to a comforting conclusion. If you have any questions, then please type them in the comment section below. Do like this video, share it with your friends, and I'll see you 3 days from now. Until then.